Hello and welcome to our second lesson in this module on private companies and our case study with KakaoTalk and also our own company, Capital Capable Media LLC, that runs Breaking into Wall Street and Mergers and Acquisitions. This time around, before diving into the case study itself and getting started with Excel, I want to give you a brief overview of the key differences when it comes to modeling and valuing private companies. I found that sometimes if you just jump into Excel, you get a bit ahead of yourself, and it really helps to take a step back and understand how and why private companies are different first. So we'll go through all of that here, and then over the coming lessons, you'll see these put into practice with the two different private companies that we are looking at in this module. The most common question here is that people will often approach us and say, private companies must be completely different because they're not publicly traded. You can't calculate market cap or equity value. They don't have a share price. How can you work with them? It seems impossible. They must have completely different valuation methodologies. And if you actually step back and think about it, that's not really the case. It really depends on the type of private company that you are dealing with. And we'll look at some examples of this coming up soon. But if you think about it logically, there are private companies out there that have billions of dollars in revenue. And then there are private companies that consist of a laundromat or a series of laundromats or a small restaurant or an accountant or a lawyer practicing independently. Now, technically, all of those are private companies, but it stands to reason that a company with $1 billion in revenue selling subscription software is quite a bit different from a local tax accountant who's just starting up his own practice. So you really have to hone in on the type of private company first before you can say anything substantial. This is a bit of a simplification, but in our opinion, there are really three main categories of private companies. First off, you have actual small family-owned businesses or other types of businesses that are heavily dependent on one person. Now, examples include, again, the company whose websites and materials you're looking at right now, Breaking into Wall Street. But even something like a high-end restaurant in New York City, if it is owned and managed by a small group or it's dependent on a key chef or something like that, that would fall under this category. Obviously, McDonald's or Burger King would not, because they're franchises, they're huge with thousands or tens of thousands of locations. But we're talking more about restaurants with just one location or just a few that are very much family-owned and run businesses. Something like a law firm, for example, would also be in this category. And these types of businesses and companies are the ones that are the most different overall. And so you're going to see the most tweaks and modifications pop up when valuing these types of companies. Now, the second category here consists of venture-backed startups that are planning for an exit. Now, in the tech space, these are different because in a lot of cases, they are effectively pre-revenue. Instagram was like that. Tumblr had some revenue, WhatsApp had some revenue, and KakaoTalk, the company we're looking at, had a lot more revenue than any of these companies at the time of the case study. Now, when you get up to this level, companies start resembling publicly traded companies a lot more because you have a board of directors, you have an actual management team, and once you get up to a certain size, maybe you don't have revenue, but you have employees in clearly defined roles, and the business could continue running even if the founder leaves, or even if the CEO leaves, or some other high-level executive leaves, because it's not all dependent on one person. And that's really the key difference between this category and some of what is up here. There are small businesses that have $100 million in revenue or tens of millions of dollars in revenue. I've seen them myself personally. But even at that size, it doesn't necessarily put them in the category of being more like a public company or being more like a venture-backed startup because it's not really about the revenue they're earning. It's really about this issue. Are they dependent on one person or a few key people? Or is it more diversified? Do they have a board of directors? Do they have a management team? Do they have all these other checks and balances in place? And that's what really separates these types of companies from the first category that we looked at. And then the third category here consists of really large companies with boards of directors and management teams, and for whatever reason, they've never gone public. Or they have been public, but they've been taken private by a private equity firm that has bought them out and acquired the company. So examples here would be SAS or SAS Institute, which makes business intelligence and analytical software. They were founded in the 1960s or 1970s. They are still owned by two individuals. One of them has around 2/3 of the company. The other owns about 1/3 of it. And they've just never chosen to go public. They run the company in a very, very distinct way and have extremely low turnover and excellent lifestyle for their employees. And they just do things their own way. They have several $billion of revenue as of the time I'm recording this. So they are huge with thousands of employees. And really, even though they're private, they're run more like a public company because they also have a management team. And they have a lot of the other checks and balances that you would see at a large public company. And I have some other examples over here. Cargill, Koch Industries, run by the Koch brothers, and then IKEA, which of course you're probably familiar with as well, a large European privately held company. So when you get to this category number 3, there aren't that many differences. Even though companies here are still private, they are largely resembling public companies more and more. So you see the fewest differences when you get to this category. So with those 3 categories established, let's move on to the next part now and go through some of the ways in which private companies are actually different. Bearing in mind, again, a lot of it comes down to which category of the 3 that we looked at they're in, and also the purpose of your valuation, whether it's for an IPO or for an acquisition or for fundraising, or for selling off a very small stake in the company, or something like that. First off, we have accounting and 3-statement projections. And the differences here are largely issues for small businesses, not for tech startups or biotech startups or large private companies that are more like public companies. On the valuation side, the differences here really apply to all the categories we looked at, but the key thing to note is that private companies are often worth very different amounts depending on the buyer or the investor. Now, this is true of almost all companies to some extent. They're worth different amounts to different potential buyers because of synergies, because different parties can afford to pay different amounts, because different parties are more or less interested. But with public companies, the assumption was usually that we could value them on a per share basis, and it doesn't matter whether we own 10% or 1% or just one share of the company, that share is worth the same amount to everyone. With private companies, that assumption is not going to hold up as well, and so we're going to look at that in detail and see what a company like the ones we're examining might be worth depending on who the buyer is. And then, as I mentioned, you will often see a lot of discounts applied here on the valuation side because private companies of all types are less liquid than public companies, and especially small family-held or family-run businesses are much less liquid than any public company out there for the most part. When you have an analysis like the DCF, the discounted cash flow analysis, it gets challenging because you don't have a current capital structure for the company. You can't easily calculate their market cap. And so items like cost of equity and WACC, the weighted average cost of capital, are tougher to calculate. With merger models, we've actually covered these previously, because if you remember, in previous modules, we looked at this deal between Suntory and Beam, and Suntory was a private company. Now, as a result of being a private company, they were not able to issue stock to do the deal. So it was an all debt and cash deal, and there were a few other differences as well. But the interesting part here is that Suntory would actually fall into that third category effectively they are a public company because they're so large, they have a management team. It's not as if it's all dependent on one person. So we've seen an example of some of those differences. And then in the other case study, we looked at this acquisition of Eddie Bauer, which is a private company at this point in time, and saw how you typically base the purchase price on enterprise value and relevant multiples, and how you may have an earnout based on EBITDA or revenue or other target like that. So we've seen some of these differences. And really, I don't have too much more to say here than what we've already been over, because merger models are really the same for the most part. Even LBO models are pretty much the same. In fact, they're actually more similar. The only real difference is that the purchase price is going to come down to an EBITDA multiple, not a share price premium. So it wouldn't make any sense to go in and offer 25% premium to the company's current share price if the company is private, because they don't have a share price. They don't have publicly traded shares. So you're typically going to base this on an assumed EBITDA multiple instead. And if you look at some of the case studies and the bonuses that we have for the LBO modeling modules on the site, we have a few examples of how you could base the model on a simple EBITDA multiple instead. So I would encourage you to look at those. With that done, let's go through each of those categories in a little bit more detail now and look at some of the differences and the challenges that come up, starting with accounting and projecting the 3 financial statements. Often, private companies give much less detailed information, if they even give anything at all. So they will often have shorter time periods, which means that it is much more difficult to extrapolate trends, and you may need to look at comparable public companies to get an idea of what a private company's actual profitability might be, for example. So in our case study here, we're lucky because we actually have 5 years of historical information for the company we're analyzing. But that's actually quite rare in real life, and often they'll only give you 1 year or 2 years. So you will need to either go back and request more, or if you can't get a good sense of the trends, you'll have to look at comparable publicly traded companies instead. Often, the financial statements are presented in a way that is not really compliant with GAAP or IFRS. So here, for example, the way that I've listed the financials for this company, we have gross sales at the top, then we have commissions, and then we have fees and refunds together, and then we have net sales after fees, refunds, and commissions as well. And then we have operating expenses split into many different categories, and then we have income taxes and net income at the bottom. This is not even that bad, and it's actually very similar to how I prepare statements internally for our business. The problem is that you can't really set up and prepare the statements this way if you ever want to sell the business or take it public or do anything like that. So we're going to look at how you might convert and turn it into something that is much closer to what an actual legitimate publicly traded company would look like. Another issue with these types of companies is that there is a distinction between salaries and dividends. And often the owner of a small business like this will not actually pay himself a salary. Instead, he will just issue dividends to himself, often to save on taxes, because sometimes dividends are taxed at a lower rate depending on the country you're in, but also because sometimes dividends are just taxed at the same rate. So he will just withdraw money from the business when he needs to use it for personal reasons or to pay for something personally. And so he may not even record a salary for himself on the financial statements at all. Here, for example, if you go down, we don't have a salary for the owner of the business, me, anywhere. But if you go to the cash flow statement, we have this item for dividends/owner draw. So these are not exactly dividends. These are really me just withdrawing a certain amount of money from the business each year to pay for various other things that I had to buy in real life. Now, again, if you want to market this as what could legitimately be a public company that could continue on without me even being there, you have to change this around. And you have to allocate some of these expenses on the income statement and assume that you hire people to do a lot of what I'm doing right now. So we'll look at how you do that later on. often you see intermingled business and personal expenses. Here, for example, we have this line item for travel and moving expenses, and this is arguably something that should not really be there for a legitimate public company or for a larger company that has stricter governance, because a large portion of this, realistically, I can't really count as a business expense because it has nothing to do with the business or customers or anything like that. So we have to go in and remove something like this in most cases. A few other things to point out here. Often you will apply some type of discount to projections for a company, because if a key employee or a famous chef at a restaurant, for example, leaves, chances are a good portion of the regular customers will also leave. So you have to think about that. And then one final note is that the tax rates may be different, because the rate on personal income or small business income may be a lot different from the rate paid by large corporations or by the acquirer in an M&A deal. So you really have to think about this and pick the appropriate tax rate depending, again, on the purpose of your valuation. One final thing I'll point out before we move on is that most of these issues are confined to actual small businesses, but they can come up anywhere. When Groupon went public, for example, they had a lot of controversy because they used this adjusted consolidated segment operating income, which essentially backed out their marketing expense spent to acquire new customers because they didn't consider it to be representative of their ongoing business. Now, of course, this is complete and total nonsense. You can't just back out a huge expense like marketing to win new customers, because your business probably wouldn't exist if you never got new customers. But they went ahead with it anyway. And of course, the SEC in the US fought back. They went back and forth over it. And I don't even recall what the final outcome there was exactly. But essentially, they had to be very clear that these were non-standard, non-GAAP measures, and to let investors know about it before they could actually judge the company. Of course, we know how all of this went for Groupon. The stock chart tells the story pretty well. They went public, and the stock price pretty much crashed within a year or so afterward. So things did not go very well for them, not the least because of issues like this with their own accounting. So I just wanted to point this out to show you that it's not just small businesses with only 5 or 10 people that face these issues. Even larger, much larger private companies can have accounting issues that need to be adjusted or taken into account as well. Now, on the valuation side, this is where you see the next crop of differences. The first thing you need to think about is, what is the purpose of the valuation? Are you going to sell to a private company or to an individual? Are you going to sell to a public company or take the company public or raise funds at a certain valuation, and that's why you need to value it? Are you going to spin off the company from another entity? Or are you going to do a divestiture? So you need to think about that first. And the reason why you need to think about that is because, as we'll see in the Kakao case study, depending on the type of buyer and the type of transaction, your discount rate is going to be different. You may or may not apply a private company discount at all, depending on who the buyer is. And then even something like the equity value that you use when calculating WACC, for example, may be different as a result of all this. You'll often see an illiquidity discount, or sometimes it's called a liquidity discount, applied in acquisition scenarios under the argument that private companies are worth less than public companies because you cannot buy and sell their stock easily. And the exact numbers vary a lot. I've seen everything from 10% to 30%, sometimes even more applied. We're generally going to stick to lower numbers for Kakao Talk because effectively it's very close to a public company. But for the other case study, for our own financial statements and projections here, we are going to think about this in a little bit more detail and see if we can come up with a better way to estimate what this might be, or at least feel more comfortable with our estimates. As I said, this discount might be anywhere from 10 to 30%, depending on who the buyer is. This discount is often applied to comparable public companies, but not necessarily to precedent transactions. And the argument here, basically, is that if you look at a valuation summary, for example, all these multiples from public comps, these correspond to public companies. But with the precedent transactions, a lot of these were actually private companies, or at least a good portion could have been private companies. And looking at it, we can see the logic pretty well. A lot of these, pretty much all of these really, with one or two exceptions maybe, were private companies that were acquired. So does it really make sense to discount the multiples when a good portion of the set that you're looking at also consisted of privately held companies? Maybe, maybe not. I've seen it argued both ways. We're generally going to stick to only discounting the public comps here, but you could certainly do that for the precedent transactions as well, and even for the DCF, depending on how you've set it up and what other discounts you've applied. What to do here really depends on what types of assets the firm owns, how big it is, how well it can generate cash flows, and then, again, what type of deal it is. Is it a minority stake, a majority stake, a 100% stake? It really comes down to factors like that. Generally speaking, if the firm is bigger and in better health, you're going to have less of a discount. If it has been generating cash flows more consistently and effectively, you're also going to have less of a discount. And if it actually owns a diversified portfolio, the buyer we're speaking about here. So if the buyer actually has diverse holdings all over the place, you're also probably going to apply less of a discount here. To get estimates for what this discount should be, you could look at something like the performance of restricted stock versus normal stock. Some academics recommend doing that. We're not really going to bother in this case because so much of it is subjective anyway, but you could do something like that if you wanted to see what type of discount might be appropriate. Now, the last topic here, the discounted cash flow analysis and WACC, weighted average cost of capital. So a few things to note on this one. We'll start with cost of equity and WACC because it's somewhat easier to explain the problem there. If you remember how we generally approach this for some of the other valuations on the site, we unlevered beta for all the comparable companies, and then we got the median from the set, and then we relevered it based on either the company's current capital structure or optimal capital structure. And then we calculated cost of equity in a bunch of different ways based on the historical beta for the company, or based on its current capital structure, or its optimal capital structure, whatever that means. And then we calculated WACC in several different ways as well. So we did that there. The problem, though, is that for a private company, you don't have its current capital structure or even its optimal capital structure necessarily. So it's not as easy to relever beta as it is for an actual public company like we did in earlier case studies. And so you need some way of establishing how much debt, preferred stock, and equity it should have. Or if you're not doing it that way, pretend that it's a public company and see how much it would have currently if it were actually a public company. So you could take the industry average or the average from the comparables here. In our KakaoTalk case study, we are actually going to be doing something just like that. So we're going to look at weighted average cost of capital and take the median from the comparable companies and use that to get to numbers like cost of equity and WACC. Another approach is to look at optimal capital structure if you have an idea of what the company's moving to in the future and use that. You could also use circular logic where the DCF output is fed into the company's own market cap for use in this equation. So going back to the valuation example, here, if we wanted to, we could go to the DCF and say, okay, we have an implied equity value. Let's just go back to our DCF or our WACC calculations and plug that in for the equity value and just use that. Now, obviously, that creates a lot of circular references because of all the ways and methods in which these formulas are linked, but that could be an option as well. And then finally, to get a better sense of beta for a private company, you could track the volatility of earnings for the company versus the S&P 500 as a whole for US-based companies, or versus the local stock market in other countries if you're in another country. So those are some options for determining this. If you are thinking about selling to a single individual or to a private buyer, this is obviously more relevant for actual small businesses. You might use something called total beta and assume a much higher discount rate as a result of this. The problem here is that the concept of beta assumes that you have a diversified portfolio and it just measures incremental volatility. So it says, if you're already diversified and then you invest in this one other company in this market, how much additional risk and volatility would you get? But it doesn't really hold up here, because if it's an individual, it's going to be a ton of risk for most people out there to buy something this large. For the cost of debt and the cost of preferred stock, you could look at comparables. You could try to estimate the default spread for the company based on its interest coverage ratios and leverage ratios. Remember how earlier we did something like that here, and we tried to look at the company's coverage ratio and then estimate what their credit rating might be, and then estimate the spread on debt above the risk-free rate based on that. So you could go through an exercise like this as well. If the company has recent debt issuances, you can look at the yield to maturity on those. So those are some ways to get around this issue. One other thing I'll point out here with the DCF is that the concept of terminal value may not actually make sense. Now again, for a company like KakaoTalk, yes, terminal value is fine because they're professionally run. It's a venture-backed startup. They have a management team, a board of directors. They will continue on even if one person or two people or whoever backs out of this venture. The problem, though, is that when you have a much smaller business like ours, for example, it's obviously heavily dependent on me. I'm doing all the recording and editing and everything like that. But more to the point, it would be very difficult to find someone to replace me entirely. And so this whole concept of terminal value in a DCF, it may not actually make sense. Because the truth is, if I decide to leave or do something else, the business is probably going to fall quite a bit and eventually go to zero when I'm gone, or if I decide to retire, in quotes, and go on and do something else. So this concept may not actually make sense. Fred Wilson, a popular venture capitalist blogger, has a really good blog post that lays this out. It's about how to calculate a return on investment. But the point he makes is that oftentimes people assume that if you invest $400,000 in their business, it's going to generate $100,000 a year. Therefore, that's a return of 25%. The problem is that this assumes the business lasts forever, which, of course, almost never happens. So what he recommends doing is figuring out what the business would actually look like if, say, it ran for 4, 5, 6, 7 years, but then completely stopped after that. Would you still get an acceptable IRR? Would you still get an acceptable money-on-money multiple? So he recommends doing something like this. Again, I recommend just looking at the entire blog post and going through some of these materials because they will be very, very relevant and helpful as you think about this. If you think about it another way too, even large public companies fail and go out of business all the time. So in our view, terminal value doesn't even necessarily make sense for huge public companies, let alone much smaller private companies. So to figure out the proper discount to apply, you could do something like assume that there's a finite life to the company instead, or use its liquidation value at the end of the period, or something else of that nature. That really takes us to the end. So let's do a recap and summary and just go over some final thoughts here. With private companies, the two key questions to ask are what type of private company it is, and then also what the purpose of your analysis is. If you understand these two, you will be ahead of 90% of people who just kind of jump into it without ever questioning what they're doing or why they're doing it. Most of the major differences are actually valuation and DCF related, but if it really is a small, closely held, family-run business or something else like that, then yes, you're going to have non-standard financial statements. You'll have to tweak how some of the projections are working, and so on and so forth. There aren't really any new methodologies or multiples or anything like that. I hate to disappoint you, but that's completely true. So you're really just seeing variations and tweaks of old ones. And that is what we're going to be focused on in this course. So coming up next, we're going to be going over data gathering for private companies and then how you might adjust and then project the financial statements, once again using the two examples that we've been using and will continue to use throughout this module.